Now we are looking at chapter 10, performance evaluation. This chapter does not have a lot of calculation, and this will not be the real focus of this semester or winter session. And but it's still not. I'm not saying it's not important. Many of these concepts in the evaluation will be in the cost accounting or the cost accounting class you're going to take in the future as a accounting major, if you take it. And we're going to briefly introduce the concepts here and a little bit calculation when we talk about the flexible budgeting, and we'll talk about the return on investment and so on. And calculation shouldn't be very different or difficult, and we're going to introduce some key concepts in here, but not most of the concepts can be found in the book, and the book has very good explanation. So this presentation is basically give you some general idea what has been covered here. So the first objective is to understand centralization and describe different types of responsibility of centers. And key idea here is, okay, what are those responsible centers? What do they do? So decentralization is to split operations to different operating segments. We're going to look at the segments of basically those centers. There's some advantages, disadvantages. It's going to free up top management's time, because each center or each segment is going to work on by themselves to reach the goal of the business. And an advantage is to use expert knowledge, because managers will be focusing on one area, so they can be expert in one area but not expert in the others. Improves customer set relations, because it'll be focusing on different segments of the products or different areas, and so the customer service or products will be targeted to those customers, and managers will have more energy and efforts can be put into improve the customer relationship. Provides training, again, as it's focusing on one area, and training will be possible and will be focused. And the last one is improves motivation and retention. It'll be employees and managers in one segment will be again focusing on one of the areas they are they have they're skillful about, and they have skills, and so it's going to have they can perform better with the skills they have, and they can get better chance of moving up to the upper level of the company, and so it's going to improve employees' intention to stay with the company. Some disadvantages: duplication costs, because so you're getting different centers and there'll be duplications in between, and so it's going to be a little bit waste. Potential problems of achieving goal congruence. Again, each section or segments are working on their own, and so there might be conflicts between each segments, and then there might be something called an agency problem. They're going to be focusing on their own segment without considering maybe the adverse impact onto the other departments or other segments. So evaluation system here provides upper management with feedbacks. So we're going to look at the system, and to be effective, performance evaluation system should have clearly communicate expectations. And so because we have multiple segments, or centers, and each center should know what are expected. Provides benchmarks that promote goal congruence and coordination between segments. So benchmarks are for the comparison, and I need to have some way to have them to compare how well they are doing or badly they are doing. Motivate segment managers. Managers must be motivated to work in his own segment. So this is kind of a segment we're looking at: responsibility centers, and then we're looking at responsibility accounting. And part of the organizations whose manager, it's a typo here, is accountable for planning and controlling activities. And we're going to look at those centers. And accounting system is to evaluate performance of each responsibility centers and its managers. Again, a typo. Okay, just disclaimer, these typos are by the authors, but not me. I haven't catch up, so I didn't catch up either. So their responsibility centers are cost center, revenue center, profit center, and investment center. Book has very good explanation, although it's short, on what each center is about. And managers in the cost center, they are accountable for the costs. And revenue center are accountable for the revenue, and profit center, they account for both revenue and the cost. So the cost center managers are focusing on how they are going to control costs to meet the budget. And the revenues is how to improve the revenue so that it can meet the budget, sales budget. And a profit center is the budget for the profit should be met, so they're going to see how they can control the cost and improve the investment. Sorry, not investment. Improve the revenue. And investment center is, see here is like a Frito-Lay division. Managers are responsible for income and invested capitals. And we're going to take a look at the how this works. And actually, ROI, return on investment, is one of the most important indicator to see how company is doing or division is doing. So we're going to develop performance report. This is one of the two most important things we'll learn in this chapter. So performance report compares actual revenue and expenses to budgeted figures. So budgeted revenue and expenses. If there's variance, the difference basically between actual budget, whether it's favorable or it's unfavorable. Favorable causes operating income to be higher than the budget. Unfavorable is lower than budget. And management by exceptions. Okay, we are not going to really focus on this one. And here, this is a partial performance report. It's very simple. So the company has multiple products, and it's actual sales. There's budgeted sales, and then we see what are the differences. So difference is always positive, but when it's if the actual is less than the budget, and give the amount, then it's U is for unfavorable, and then we see how much unfavorable do we have. Is 1.37% lower than the budgeted sales. And we'll do the same thing to calculate, and we see the worst one is for this product, and it's unfavorable for 8.38. So actual sales is a lot lower than the budget sales in terms of percentage compared to the other products and companies. I mean, take a look at what's going on for this one. And for the favorable, of course, it's good. But still, companies need to still consider how do we improve. And actually, the better budget. We're always looking for the actual sales more than budgeted sales, but if the difference too big, we want to see how are we doing our budgeting. Is that an accurate indicator of the expectations here? Okay. Second margin, the operating income generated by a profit or investment center before. Okay, here's before subtracting common fixed costs that have been allocated to the center. So let's take a look. So the numbers in red is sales revenue minus expenses minus the fixed costs. It's a direct fixed expense, and we have two types of fixed expenses. One's a direct fixed expenses, and another one's a common fixed expenses. So direct fixed expenses are those costs that can be directly linked to the cost of the product or cost of sales. And here, for example, advertisement, there'll be direct fixed cost increasing in the direct in the advertisement. Basically, is marketing effort. And here for the common fixed expenses, for example, the office expenses, the salaries to the staff, and the CEOs and the managers work in the corporate office and so on. Okay, so this is segment margin here. Organization-wide performance report is a report for each level of a management flow up. So we look at picture of different segments, and then we look at the big picture of bigger picture, and we'll move up to the organizational chart. So there might be controllable variance and maybe uncontrollable variance. So for controllable variance, of course, I want to see how are we going to say, for example, to increase our income and so something like that. And uncontrollable variance are the something that's not controllable by the management. So for this part, companies may want to see how do we minimize the risk associated with the uncontrollable variance. Uncontrollable variance may be the cost of electricity, gas, and so on. So increasing the cost and like this may not be controllable by the company. It's because the market is going up, right? So third goal is to calculation here. ROI is the one we calculate. Just make a correction here. Our real focus is in here, but not object number 2. And how do we do the calculation for ROI? Return on investment. How do we find a sales margin? How do we find a capital turnover? They are not very difficult. There are only 3 formulas in this one. So evaluation of investment centers. So we're going to see how we are going to do the evaluation on this one, and we're going to have ROI, and also we have a residual income. So we're going to look at each one one by one. So return on investment, very, very, very important indicator of how company is performing. It measures the amount of income an investment center earns relative to the size of its assets. So basically it's income divided by total assets. It's operating income. Okay, I'll just correct that. Operating income divided by total assets. This is the formula. So we can see that operating income is the income before interest and tax, EBIT, earnings before income and tax, divided by total assets. And there are 2 more terms we're having here is the sales margin. Sales margin, again, is going to see for each dollar of sales, how much operating income have been generated. So it's going to be operating income divided by the sales. Capital turnover. Capital turnover is for each dollar of the total assets we have here, how much sales have been generated. So ROI is simply a product of sales margin and a capital turnover. So if you do this simple math, sales here, they cancel out. So ROI is again is operating income divided by total assets. So these three items have the internal relationship in here. Is ROI equals to sales margin times capital turnover. So we need to know all these three formula here. So ROI, again, return on investment equals to operating income divided by total assets. Sales margin equals to operating income divided by sales. And a capital return equals to sales divided by total assets. Here's an example. So here example has three different functions here. Functional ingredients, consumer markets, and performance materials. And we have operating income for each, and we also have the assets for total assets for each, and then we have sales revenue for each. So we have all these three, and we can use that to calculate each division's sales margin, capital turnover, and return on investment. Return on investment, again, is operating income divided by the total assets. So it's this one divided by this one. Sales margin is for each asset dollar, how much sales have been generated. So you see revenue divided by the assets. Sales margin. So it's operating income. Sorry, operating income divided by sales. So I use the operating income divided by the sales here, and capital turnover is to use the sales divided by the actual total assets. Sorry, total assets. So we are going to have all these three calculated. So these are calculation here. Sales margin is a 5720. Operating income divided by sales 22,000, 26%, and a capital turnover, and we have this is the sales divided by the assets, and we have ROI. It's 26 times 2.2. So this is a product of both. Okay. And so the other ones are the same, exact same way, but different numbers. And we're not going to go through this in the slides here. Another concept is called residual income. Residual income determines whether the division has created an excess or residual income above expectation. So it will be operating income minus minimal acceptable income. So minimal acceptable income is the targeted rate of return times total assets. And so we have return RI is residual income equals to operating income minus target rate of return times total assets. So we have something like here. This is another example. We have a sales, we have operating income, of total assets, and we have a 13% rate of return. So 30% times 4.9 million is expected. Operating incomes of 950,000, and you use this one minus this one times 13%. This is a residual. So let's take a look. So 950,000 minus This one times 13%. So we have positive also for the non-standard sports return. Residual income is also positive, and that's good. And so we're actually generating better performance in the income than the expected. Goal congruence. Residual income enhances goal incongruence, and ROI may or may not. So the book has a very good explanation on this one, and just go ahead to read the book. Chapter goal congruence is basically what has been expected by the top management, and also what the division managers are going to do. Are they going to the same direction? So this is kind of goal congruence. And a residual income uses different way to calculate than the ROI. So they're going to provide different output to whether it's going to have a goal congruence or not. So there's some measurement issue here. And when we do calculation, we need to do some measurements. Some measurements mainly is, okay, what balance sheet data are we going to use? Should we include all assets? Assets maybe some assets are not going to generate any income. Are we going to include those? Something like the new store still under construction also, or land has been purchased and so on. Those are the assets we have here already, but they're not generating any income until they're finished. So are we going to include those? Should we use gross book value or net book value? Gross book value is a historical cost. For example, equipment, $10,000 we purchase equipment, but equipment as a fixed assets, and it will be depreciating. So net book value is going to drop, and the way to calculate net book value is to use the book value, the cost, historical cost of the equipment or other fixed assets minus accumulated depreciation. So I'm going to use this one or this one. This is a question. How do we use this? Because they are going to have effect on the return on investment. Should we make other adjustment to income or assets? So there might be some other considerations by the company. They may want to make adjustment to income or assets. So do we do that? So there's some limitations of financial performance evaluation. Mainly is the short-term focus. Because when we do the financial performance evaluation, it's only for the past period. It's a short. So if the manager wants to, they focus on the numbers generated in the performance report, they're going to focus on this short period. They may not focus on what may happen in the next 5 years. So that could be some problem companies may have. For example, companies may prefer to use the equipment, old equipment, because if we use net book value as here, net book value of the assets as the performance calculation, so return on investment will be operating income divided by total assets. If the total assets value is small, and return on investment will be bigger. So if we use, in the short here as use old equipment, and then the net book value is going to decrease every year because of the depreciation, and then we will get to see return on investment getting bigger and higher. So, but that's going to generate a better return on investment, but it's not good for the company because company is not getting new equipment or new technology to the company to improve their efficiency. So that's some consideration whether we are focusing on the short term or are we going to focus on the long term goals. Next one is to describe strategies and mechanisms for determining transfer price. Transfer price is the one that we're going to use between divisions, and they're going to transfer one product to another division, and how much do they charge? Okay, just get some idea of this, and we're not really going to focus too much on this one. The price charged for the internal sale between two different divisions of the same company encourage a transfer only if the company would benefit by exchange. It's vertical integration is an improvement. So this is from the book, and there are three different strategies: market price transfer, there's advantage and disadvantage, negotiated prices between the two divisions, and so there'll be advantage, disadvantage, and what considerations we have, and a cost or cost plus a markup, and it's also has advantages, disadvantages. Company may use one of those or combination of multiple of those strategies, depends on the considerations they have. Another consideration is global considerations, because companies are facing global market, and even companies may have a the divisions of the companies. So in here, do the divisions operate under different taxing authorities? So one in Japan, or let's say one in Canada, one in United States. Canada is famous for charging a lot more tax than the United States. So then the calculation may not be accurate if we have different tax authorities. Will the amount paid to customer and customs, and duties be impacted by the transfer price used? So that's also some consideration here. And I will move on to flexible budgeting. Flexible budgeting is the key thing in this chapter here. So we're going to take a look. And concept-wise, it's very simple. And let's get some idea here. Flexible budget is a budget prepared for a different level of volume that which has originally anticipated. Originally anticipated is a master budget. So master budget may not be as accurate because we may have sales, for example, volume sales are much higher than the master budget has. So difference will be called it's called a variance. So a difference between the actual revenue and expenses and a master budget. And so here we say, okay, so apple to oranges comparison, because the increase in the revenue in the actual sales and also expenses, and it may due to many different reasons. So the difference here may not tell a lot of useful information, and you can take a look at the book. The book has a pretty good explanation on how this apples and oranges comparison is happening, because for example, some fixed costs add to the actual sales, and it's going to have it's going to increase the unit cost of each one. And so when you have different unit costs and revenue and the expenses will definitely is going to change. And so, but if we do not look at the mechanism and the details of each expenses, and then we look at a total, that can be meaningless, because you're going to compare different. Sometimes you even add some costs into this, and it's going to compare something different categories. So something has, something doesn't have, and this comparison will not be good. So to avoid this, and we create something called a flexible budget. So flexible budget is the process is like this. So here is our master budget, and here's our actual and actual happening. So to look at what's really happening for the differences in each line here is to compare, that is to make create something called a flexible budget by moving the actual sales volume into this side, and then we use the original percentage of original fixed cost and so on, put in here and calculate what operating expenses, and we have actually you also can get more operating income. And so we're going to look at what's the real this is actual revenue, and if we use the original $20 per case, and it's going to generate this number, but the actual number is $603,000, and this is $574,000. So what's going on here? Why this number is not $20 per case? And as we see in the flexible budget, and also for the sales commission, and so if we use $1.5 per case sold, and then we get this number, but we have a higher number, and what's going on? So let's take a look at that. Yeah, here. So we're going to take a look at the details in here, and so first one, the volume difference, the difference between the master budget and the flexible budget. We're going to take a look. All right. So when we have the volume, so basically the same volume, we moved over here. We're going to see a difference here, and then we are going to see all the differences in each one. So we look at this difference first. So we look at the volume difference, and so here is 3,724 cases favorable. So we're getting more in a flexible budget, and this one is basically the actual. It's also favorable. And then we're going to look at, hey, what's the difference between the sales revenue, and we're going to $74,480, and more than the master budget. It's also favorable. And always we calculate and unfavorable for the expenses here, and the fixed assets are the same, mainly because fixed assets won't change. So basically we see this here, and so we'll look at a flexible budget variance, so between the flexible budget and the actual results. So we're going to see, oh wow, so we have a favorable difference between a variance between the actual and the flexible, and then you're going to see what's going on here. And one of the possible reason for this one is, okay, when selling more than $20 per case, so we're generating more revenue here. And here we have a higher in the sales commission. It's unfavorable. It's possible that the management says, okay, we're going to increase the sales commission to improve the sales, as we have here. And also shipping expenses is favorable, and it's possible that the UPS or some trucking companies are charging less, or some volume discount, and so on. And the bad expenses is higher, it's unfavorable, and possible it's they have lose the credit limit also, and so, or some credit terms have been loosened, and so it's going to increase the risk. So here we have more of here. Okay, so these are possible reasons, and then we see the variance between the flexible and the master, and also between the actual and the flexible budgets. So here are some underlying courses we just talked about. And so another one's master budget variance, a combination of variance. So here, master budget variance between the master and actual. So we have a volume here. So actual between actual and flexible is 28,745, and between the master and the flexible is 74,480. So the total between the actual and the master is a total of these two. So it's 103. It's easy to find here. So if we use this number minus this number, it's 103,225. So it's 103,225 here. And same idea, we're going to calculate. So first one is the sales revenue variance, and the second one is the total operating expense variance, and the last one is shipping expense variance. So depends on what panel we are looking at, and we just look for the numbers here, and then get a total of this one and this one for the sales commission total, and this will be shipping total. So here is a favorable, this is unfavorable, and so you're going to use this one minus this one. So the big one minus the smaller one, the larger number minus smaller number, and we get this still unfavorable in the shipping. So the sixth objective is basically the balance scorecard and KPI for each perspective. This part is very brief in the chapter. Has been we have the explanation in the chapter book chapter, and the more use of a balance scorecard can be found in operations management. So in this part, what we are expecting you to bring home is to look at the balance scorecard and what are the four perspectives. There are financial perspective, customer perspective, internal business perspective, and learning and growth perspective. Balance scorecard is the management is going to consider both financial and operational performance measures. Financials are those costs and expenses, revenue, and so on. And the non-profit are, say, customer satisfaction and some other things. So we're going to also put them together to see how are we doing. So we're doing financially, how we are doing with customer, how are we doing. Internal business and learning and growth. So these are the information we want to take a look. So for each one, financial perspective, how do we look to shareholders? So basically income, we look at income. Must continuously attempt to increase profits, increase revenue, control costs, increase productivity, and so on. So those are the numbers we can calculate fairly easily with the report we have. Customer's perspective, how do customers see us? And we're going to look at some key indicators here. Key performance indicator, KPI. And we look at the price, with the quality, with sales service, and we look at delivery time. So these are the four indicators to see how we are doing with the customers. And here for the internal business, we look at three factors: innovation, operations, and post-sales support. And the last one is a learning and a growth perspective. We look at employee capabilities. What skills employees have? Do they have certificates in certain for a certain job, and so on. Information system capability, and how fast is our website? How many customers can we handle online? And and other things. So information system has a lot of things can be covered. And if you're taking the accounting as your major, you're going to take a course called Computer Accounting, actually, and many universities call that as Accounting Information Systems. We're going to take lots of information system issues in accounting. Company's climate for action. This is culture of the company. So we're going to take a look for this perspective, learning and a growth perspective. So the last part in this chapter is again sustainability and performance evaluation. Sustainability, we look at it, some key performance indicators. So how are we doing to support the community? How are we doing to maintain a healthy environment and so on? So sustainability, we have in the book, every chapter has a brief discussion on this. If you're interested, go to the book and you can get some good explanation for each chapter's concepts. All right, here's basically the chapter. It's pretty short, and again, we don't have a lot of things to cover in here, and in terms of accounting and calculation. And you're going to do several things: ROI, and we're going to have sales margin. We're going to have assets turnover. And also we're going to have how do we prepare the flexible budget, and that's about it. Okay, thank you very much, and I'll see you in chapter 11.